Ray Dalio mentioned that the stock market is currently adjusting as interest rates rise. It's a basic financial principle that the value of any asset, whether it's a stock, an apartment building, farmland, or even a small local business, is affected by interest rates. What is currently happening, though, is that the interest rate used to discount those future cash flows is rising, resulting in a lower present value for assets. That sounds complicated, so let me give you an example. Before we begin, please like our video and subscribe to our channel for more content like this. Let's get started with this video now. Assume in this example that we are valuing a stock in a company that will operate for 10 years and that we will be able to sell that stock for 5 times its year time at the end of year 10. Every year of stock yields $10 in cash flow. Assume the company can increase its annual cash flow per share by $2. Each year for 10 years results in a cash flow of $28 per share. To calculate the stock value at the end of year 10, we must discount these cash flows back to the present day using a given interest rate. We do this because a dollar received 10 years from now is not worth as much to an investor as a dollar received today in cash. I mean, which would you prefer, $1,000 in cash today or $1,000 in cash 10 years from now? Of course, you'd choose the $1,000 today. This idea is also known as the time value of money. Let's use 5% as our discount rate to calculate the present value of these cash flows. We would use the net present value equation to calculate the present value or intrinsic value of this stock, which would be $226.47. So what happens if we change the interest rate at which the cash flows are discounted? If we reduce the interest rate to 4%, the intrinsic value of this stock rises to $243.45. If we reduce the interest rate to 3%, the intrinsic value rises to $262.09. And finally, if we reduce the interest rate that those cash flows are being discounted at all the way to 2%, the stock's value rises all the way to $282.58. Notice how as the interest rate falls by a percentage point, the stock's value rises. Now consider what happens if we reverse the process and raise the interest rate used to discount the stock's cash flows. This is an extremely important point to grasp. This is what Ray Dalio is referring to when he talks about the stock market's interest rate adjustment. What's happening in the stock market right now is that while interest rates have not risen yet dramatically, investors are concerned that they will in the future. As a result, the stock market has lost value. This year, it's critical for investors to remember that the value of any stock, or any asset for that matter, is determined by 3 major factors: how much cash that stock will generate for its investors, the timing of those cash flows, and the interest rate at which those cash flows are discounted. Right now, investors are increasing the third variable, and as a result, the stock market's perceived value of stocks is decreasing. We'll get into this more later in the video, but it's critical to note that Ray Dalio believes in diversifying one's investment portfolio rather than trying to time the market. While you're here, why not invest in our channel by giving us a like and a subscription, as it'd be highly appreciated. Now let's return to the video. So we have the $1,000,000 question, or in Ray Dalio's case, the $150 billion question. What should investors do in this market? And perhaps more importantly, what return should they expect? Ray Dalio's forecast of 3 to 4% annual returns for investors is a significant departure from what investors have experienced over the last decade. Since the Great Recession, investors have routinely enjoyed double-digit annual returns. Consider the S&P 500 index's return since 2011. 2% since 2011, 16 in 2012, 32 in 2013, 14 in 2014, 1 in 2015, 12 in 2016, 22 in 2017, -4 in 2018, 32 in 2019, 18 in 2020, and 29% in 2021. This is a 14.4% compounded annual return on the S&P 500 from the beginning of 2011 to the end of 2021, assuming dividends are reinvested. This is one of the best performing periods for the S&P 500 and one of the greatest bull runs in the US stock market history. It's a well-known fact that the long-term average return on the US stock market is around 10%, but what's less well known is that the average return has been far from linear. Now let's consider the S&P 500. In the year 2000, the S&P 500 briefly crossed 1500. Do you know when it will reach that level again? 7 years later in 2007, which was a very brief time. The aftermath of the great financial crisis and subsequent stock market collapse drove the S&P 500 down to less than 800 in 2009. In fact, it would take until 2013 for the S&P 500 to be comfortably above 1500 for an extended period of time. This means that investors who invested at the peak of the stock market in 2000 did not see a return on their investment until 13 long years later. This also means that the annual return for the 13 years invested was 0%, excluding dividends. If dividends are included, the figure is likely to be around 1 to 2%. In retrospect, investors from 2000 to 2013 would have been content with the 3 to 4% returns Ray Dalio is mentioning now. Ray Dalio's future return projections become even less exciting when inflation is factored in. According to Dalio, a 3 to 4% annual return would be just enough to break even after inflation. This means that Dalio anticipates annual inflation of 3 to 4%. As investors, we should be concerned with what is known as our real return. Simply put, this is our return on investment minus the inflation rate during the year. Assume Ray Dalio is correct and future returns over the next decade average 4% annually. Let's also assume Dalio is correct about inflation and the average annual rate of inflation is 4%. This means that we take our 4% return and subtract the 4% inflation rate, yielding a 0% real return. This brings us to the most important topic of this video. How can we as investors position our portfolios to generate the highest possible return with the least amount of risk while still mitigating the impacts of inflation? Ray has two specific pieces of advice to answer this question. The first one is to not hoard cash. Cash, as Dalio says, is trash. With the stock market nearing all-time highs, it may be tempting to attempt market timing. Some investors may be tempted to sell their stocks and hold large amounts of cash in order to wait for the stock market to crash and then buy at the bottom. However, Ray Dalio has warned that market timing is a fool's game. In other words, just because the stock market is overvalued doesn't necessarily imply that a crash is imminent. Indeed, Dalio has been adamant that holding cash is the worst possible investment. The reason for this is because of that pesky word, inflation. Going back to our earlier example of calculating the real return on your investments after inflation, let's say stocks return 4% and inflation is 4%, which means your real return is 0%. But if you're holding cash, your return on cash is 0%. After deducting the 4% inflation rate, your real return on cash is negative 4%, and a negative real return is only slightly worse than a 0% real return. Dalio's next piece of advice is to diversify your portfolio. This could honestly be its own video, but I wanted to touch on it briefly in this video. Dalio is a firm believer in portfolio diversification, or to use an old adage, not putting all of your eggs in one basket. This means that investing 90% of your portfolio in Tesla stock, for example, may not be the best strategy. Instead, Dalio advises investors to construct a portfolio of investments that will perform well in all types of economic environments. While he was constantly watching the market and the economy, he himself admits that he can't predict the future. And that's all there is to it. It's really amazing to learn from an investor like Ray Dalio, and as always, thank you for watching. Before you go, please like and subscribe to our channel for more content like this. We'll see you soon.